Hi, my name's Ben Shepard and I'm the editor of Global ETF Profits. The United States Federal Reserve is a fairly unique institution in that it's charged with a dual mandate. It's responsible both for maintaining price stability and working towards ensuring full employment in the economy. Most other central banks around the world are charged purely with inflation control. They're just out to maintain price stability. That dual mandate leaves the Fed walking a very unusual tightrope because typically actions that you would take to tamp down prices could also reduce employment in the economy and vice versa. So as probably everybody's aware by now, the Federal Reserve is talking about embarking down the path of another quantitative easing program. For most folks, that conjures images of firing up the printing presses, but it's definitely a much more high-tech process these days. Basically, the Federal Reserve goes into the market and says we're willing to buy X billions of dollars worth of Treasury securities. The investment banks, the money center banks, and other large institutional investors hand over those bonds. The Federal Reserve makes a book entry showing more cash on the seller's account, and voila, new money is made. The whole point of this process is to build additional inflation into the economy. Right now, the Fed's clearly worried about a deflationary environment, one in which consumers put off making purchases in anticipation of lower prices in the future. So that stifles demand, which creates this vicious feedback loop. But by building inflation into the system, consumers will expect higher prices in the future, so they're going to be more eager to purchase today, thereby stimulating demand. The hope is that with unemployment being so high and demand being so low, building this inflationary expectation will help boost the economy out of this kind of tepid recovery that we've seen it in over the past year. Typically, the Fed would rely on interest rate policy to do this. They would set short-term interest rates below long-term inflation expectations, making the cost of credit very cheap. So companies would be eager to take out loans, both for investment and expanded production, to buy more raw materials, et cetera, et cetera. It would also prompt consumers taking out loans, to buy a house, to buy a new car, just to spend more, period. But with interest rates pushing that zero bound for the better part of 2 years now, that's one arrow that the Fed's already fired and just isn't in the quiver anymore. So right now, the only real policy tool left open to the Federal Reserve is monetary policy, is printing money and basically controlling money supply. The danger here is the reasoning behind embarking down this path is predicated on this notion that the demand for loans just isn't there. That for whatever reason, whether they're uncertain about the economy, they're concerned about costs, consumers and businesses just don't want to borrow. It's true that consumers and businesses aren't particularly inclined to borrow right now, but that has more to do with the cloudy economic outlook. It's not an issue of the banks don't have the resources to lend or aren't willing to lend. In fact, the Federal Reserve conducts what's called the Senior Loan Officer Survey on a monthly basis, where basically Fed representatives go to pretty much all of the major banks and ask people in charge of lending, what's the environment like? Do you have the resources that you can lend? Are you willing to lend if the business is there? And over the past few months, the response has overwhelmingly been yes, we're ready and able to lend. In the commercial and industrial loan space, we've actually seen borrowing costs fall and lending rates increase as these banks are becoming highly competitive. They're looking for people to lend money to because it's a bank. That's how banks make their money. They take deposits in at 3%, they lend it out at 6%, and they keep the difference. If banks aren't lending, they're not making money. So the reasoning behind the Fed wanting to go down this path of quantitative easing really just doesn't hold water with me. People don't want to borrow because right now there's still so much leverage built into our economy, they don't have a need to borrow. So no matter how much money you print, that situation just isn't going to change. People don't have the need to borrow. So that sets up a dangerous situation. By its very nature, quantitative easing and printing money is inflationary. That's exactly what the Federal Reserve wants it to do. The risk here, though, is that this inflation is going to be bad inflation rather than good inflation, and there is a kind of a fine distinction there. Good inflation occurs when demand is growing, prices are rising, but incomes, what you and I make, our salaries, keep pace with those rising prices. We actually have the money to go out and spend. Bad inflation occurs when prices are rising, but incomes aren't keeping pace. So our spending power is being diminished. And in the current environment, I'm really afraid that the bad inflation is the more likely outcome, because with unemployment so high, workers just don't have the bargaining power to push for higher wages. It is quite likely the prices will increase and purchasing power just isn't going to keep pace. And a big concern for that occurring is that as the Federal Reserve is creating more money and putting more money into circulation, these major banks let's say major manufacturers are going to borrow this money, and they're going to invest that money where they can get the greatest returns and realize the greatest spreads. That's going to occur they're investing in emerging economies, other global economies, by buying commodities. And all of that occurring is going to drive up prices here in the U.S., but it's not going to put U.S. workers back to work. So basically prices are going to outpace spending power. I think the odds of that happening are fairly long, but I would say there's probably at least a 30% chance of that being the outcome a year from today. With that in mind, there are a few things that we as investors can do to prepare ourselves. The most obvious course of action is to invest in commodities. Being an ETF expert, there's one key way that you can go about leveraging commodities for your portfolio. That's the iPath Dow Jones UBS Commodity Index Total Return ETN. It's quite a mouthful, but the ticker's easy. It's DJP. Basically what it is it tracks the full basket of commodities, from energy commodities to food commodities to metals. Basically, if it trades in the commodities market, including livestock, it's included in this index. So as these prices rise, the value of DJP is going to increase along with it. So that's a great way to build in an inflationary hedge and add some profits from rising commodity prices to your portfolio. Another way to go about it, and arguably the most traditional way to go about it, is gold exposure. Spider Gold Trust, GLD. I don't think it needs a lot of explanation there. If you've watched any of the videos that I've done or read anything that I've written, you're probably more than familiar enough with GLD, but it's, again, an excellent inflationary hedge. A little different way to go about playing it, though, is the SPDR Deutsche Bank International Government Inflation Protected Bond Portfolio. Another mouthful, but an easy ticker, WIP. Most folks are going to be familiar with the Treasury Inflation Protected Securities, the TIPS that are issued here in the U.S. by the Treasury Department, the TIPS bonds. As inflation expectations rise, the TIPS make bigger and bigger payouts to compensate. Basically, you end up with the full value of the coupon that you were supposed to be paid, plus all of your principal adjusted for inflation. So you don't lose any money and you come out a little bit ahead. And with the TIPS, conversely, in a severely deflationary environment, you'll still come out with the full principal amount of your bond. So basically, this is just the whole TIPS concept on a global scale. And while TIPS would be a great investment for your portfolio, a great TIP fund is simply TIP. If you approach it from a more global perspective, I think you'll probably realize a bit better return, because here in the U.S., most of our domestic TIPS, I feel like, are way overvalued. At this point, everybody and their brother's concerned about inflation, so they've been piling into these TIPS bonds, and there's just not a whole lot of value left there. Globally, that's really not been the case. There's still a lot of value to be realized, and you can get a fairly decent 4% yield to boot. As these commodity prices rise, that's going to create a global inflationary situation. It's not going to be localized simply here in the U.S. because most commodities are priced in dollars. So as our dollar gets devalued, those commodities cost everybody more. So I would definitely consider adding some of the SPDR Deutsche Bank International Government Inflation Protected Bonds to your portfolio. Again, the ticker is WIP. I just wanted to thank you for watching, and again, my name is Ben Shepard, and I'm the editor of Global ETF Profits.